The boat is rolling. Hi, I'm Curtis.
And I'm Dayan.
If you're new, do the subscribing and do the liking.
Yeah, that business. Let's just move on.
Let's just move on, guys. So, chapter 7, enter on the market. So, yeah.
To enter on the market, we need to follow strict rules. They are common entry models that we will be able to use on the market. The entries are taken on the 1 minute time frame, but you can also look for 2 or 3 minutes if the price actions is not easy to read.
Yeah, okay.
So I do use the 1 minute, I do not use the 2 or the 3 minute, but I do use the 5 minute.
So clearly, when you enter the market, it's always good to look at the shorter time, like the very low time frame, as this is where you're going to enter your specific trade now. So the change of character entries. The change of character entries must be taken on a higher time frame, point of interest. I likely use the 50-minute time frame or point of interest and 1 minute change of character entry. So this is basically the orders where you are, but we'll be using the same measurements as the order as we will be SMC traders. So the change of character entry is a bearish model, as we can see here. So this is where the change of character entry is basically on the shorter time frame, which is the minute. So we have a break of structure, 15 minute. As we can see, a change of character happen here. This is basically where to retrace, and this is where we'll enter, put your short. As you can see, it's basically a full change of character in the trend. And here at the bottom, as we can see, is our swing low, which we want to basically take our profit. Stop loss will just be above this, and then basically this is where you'll get out of this trade as a possible trade. So this is the exact same in a bullish example, as we can see here. Change of character entry chart model. Here we have, once again, we have our order block here. Here you have your swing structure, break of structure at the minute. Change of character here, basically come retrace here, and this is where you'll have your entry. You have a 1 to 2 trade, basically here at the top. This is where you just have a stop loss of maybe like 30 pips, and from there, this is what we just saw on a chart form. So you have a change of character, comes down to retrace, and this is where you enter. Here we have that. I just zoom it in to see it, leave it so for about 2 seconds, and there we go.
Yes. For the sweep before the change of character, only a wick is acceptable, but to break the change of character, we need a candle close in order to follow it. Yes.
C1 in 3. So C1 in 3, change of character 1 in 3. So the C1 model consists to wait for a change of character, and then an internal break of structure to have more probabilities for the price to go down. So this is very core. So this is the C1 entry. So this is how we saw here, C1 entry bullish model. So here we can see, I just want to zoom this in because I see there's a little bit more wording, so I'll have it like this. If you have a resting imbalance in the extreme, it's better to protect it with a stop loss. Okay, see it. So here we have the C1 entry, as you can just read again, wait for the internal break of structure to have a more probability. Okay, so the internal break of structure is right here. Here's the break of structure. And then basically come here again. Okay, to have a more probability. Okay, so then basically this is testers, and then basically after the change of character. So what they're saying is basically after a change of character, wait to have an internal break of structure, which is here. Here's your change of character. Here we have a break of structure, as we can see here. And then basically once it tests the previous like lower low or like higher low, basically that's where you enter at this point right here. To increase a lot of probabilities to win a trade, it is used most with the gold. Okay, so this strategy is used most with gold. I haven't traded gold myself. I think I have more losses on gold.
Did you just say I haven't traded gold myself?
I mean, like, to the point using the C1 strategy.
Because I know those losses. They can speak a different story.
Yeah, they do. So the C1 entry in a bearish model. Okay, what we just said on top, the exact same. You have your change of character, you have your internal break of structure right here, and then wait for the retest on the, it's basically the reverse now, which is your lower high, and then basically that would be your entry point using the C1 entry model. Okay, what we just saw using the chart. So let's just do this. Yeah, we can see here is our change of character. The break of structure is not so much clear, as you can see. It's just a short break of structure, but then identifying on top, and then basically here's your sell side liquidity of yours basically on top, and then basically retest the break of structure, which is your lower high, and then basically goes down to create or previous lower low. Basically this could be your trade right here. The flip entry. Okay, the flip entry.
Yes. The flip entry shows a fail from supply or a demand to follow the market. In a bearish market, the supplies are in control of the market and vice versa. In a bullish market, the demands are in control. When a supply fails to follow the structure, it will flip to create a demand. The demand will take control of the market. There we go.
The flip entry model, bullish model. So here we can see here, price reacts to the last supply in control, as they just said here on top. The supply, okay, there's 3 points. Let's go in via point. So price reacts to the last supply in the control, which is right here. So it fails to make a lower low. So firstly, it fails to make a lower low, which is here, as you can see the trend, which is a change of character right here. Supply fails to create a demand, as you can see here, and then basically reaction to demand that makes a flip, which is right here, and it creates the top apart. So I'll just pause, like you can just pause the video here and then stop it and just read that once again and see from there. I'll just leave that. There we go. So we can identify a flip in 4 steps, okay, which we've just went through briefly. So price reacts to the last supply in control, which was here. Price must react to the supply to affirm it is one and not just a fake level, okay. The second part is after the reaction, price fails to create a new lower low, which is just here, after that part there. Supply fails and creates a demand, okay, supply fails and creates a demand, which is basically this here, as you can see. Price reacts to the demand created by the flip, which is right here, and that basically is your entry model for that. I think what we just said in a bearish model, as we can see here. Here we can see price reacts to the demand. Here it fails to create a high high instead of a lower low. Demand fails to create a supply, which is instead of just swapping the stuff from supply to demand, and then reaction to the supply creates a flip, which is right here on top, as you can see.
Yes. The flip has different models. The author uses 3 in total. One of them, if price doesn't create any liquidity, then he will use extreme points of interest.
Order block point of interest, we've said this is just a different word for order block.
1, when price creates liquidity and then we select the zone that makes the flip. And the last one is when price reacts to the last zone in control, it creates change of character before it breaks the zone.
Okay, so that is just, once again, I'll just leave it.
Yeah.
And there we go.
Just leave
The
it.
flip end of the model, no liquidity. Okay, we just see the difference between the two firstly. Okay, so here we have this, no liquidity. With the model, as we can see, we don't have liquidity. We use the flip as liquidity for the extreme. So the flip is right here, I think, on top here. So the flip end of the model, liquidity. So the okay, we just zoom out a little bit between these two. So they mostly look kind of the exact same. Just beside there is a phase of liquidity, which is this here. So yeah, between the two here you have your change of character, but the only difference is this here. This is your liquidity phase. So let me just zoom in. We just have it once again, and then just move on. The flip in the model, C flip. Okay, a C flip. On this model, we can see a model of change of character on the last zone in control, and this could be used as a sweep and shift. Okay, once again, flip chart example. As we can see here, we have a break of structure, creates your inner 15-minute, comes up, creates your sweep and shift here. As you can see, we're recording and trading, but you can see nothing.
Trading and recording. That's the life in the website.
Okay.
Those models are commonly used after the mitigation of a higher time frame point of interest, or when we sweep a big liquidity as external range liquidity. The following one will be when we are already trending, as in continuation trade. As a continuation trade. You can take them to stack, or because you are not there when the market shows your entry criteria.
Oh, the continuation trade model. Okay, so basically just like this, they always say this term in trading, your trend is the friend basically. So you can basically continuation trend model. As we can see here, as if you're looking at a bullish example, you always create your higher highs and higher lows. So basically this is a continuous trend in this here. I think it's your external range liquidity, which is undecisive if it's gonna basically continue its high position or not. So you can see here at the top you have your high, basically have a little bit of consolidation, creates its high low, continue its like trend, creating a break of structure and basically creating a high, continuing again creating its high low, and then continue basically. So this is your standard. We've looked at this probably like across the series a few examples. Make sure to always follow the rules of the zone selection to choose the best point of interest. The continuation trade for me needs a breaker structure, momentum and liquidity. That is the most important rule. So I think we also identified 3 of the rules when identifying an order block. It needs to have a breaker structure, it needs momentum in the market, it needs liquidity, it needs a little bit of an imbalance or fair value gap. We've mentioned this stuff when identifying an order block.
And it needs inducement.
Inducement, yeah. So the continuation trade chart model, so once again here we can see you have a breaker structure creates the like lower low, since this is a bearish market. Here you have your external range liquidity on the upside, you create your high low content. So let's just look at the fair value gap, which is a different word for imbalance. Yeah. So yeah.
Fair value gap means okay. Well, there
fair
you go.
value gap.
Fair value gap. That's another name
yeah.
for imbalance. Fair value gap is used when we have a big candle after our point of interest, our order block, and in this big candle we will take the 50% of the imbalance and take our entry at this area. Why doing this? Or why do this? Apparently his English failed him there as well. When we have a big amount of imbalance, price will not necessarily need to tap into your point of interest to follow. Taking care of that, the 50% works very well for the reaction of price. Right, I'm done with English now.
Okay, we are both done with English. We are losing it all. Okay, let me. The FSG or fair value gap is, as you can see, this is where there's a big candle on the upside. Well, I think we'll have an example of looking at a chart, but this is basically a fair value gap here. And using the 50% model we set on the candle example on your trading view, this is where you identify your like recommended or most probability entry point in this trade. As you can see here, this will identify a possible entry zone. This is why the author did it here, and it basically created a buy trade here using his 1 to 2 at this point, which is this here identifying a fair value gap, which we've covered on the channel so far. As you can see, this entry decreases a lot of risk, the risk reward. It's all on you if you want to use it or not. For what concern my experience, I use it when I can get a minimum of a 4 RR risk reward. It's better to know this entry in case the price doesn't react to your zone. If you the zone, and if you are asking yourself why it happens, to implement this entry could be very great when you are in a pro trend and can have a big take profit. Okay, pro trend means you are following the trend, because basically just your trend
and
is the friend.
A lot of my successful trades actually came from fair value gaps, like recognizing fair value gaps and using them as my entry points. Yes.
Okay, and this is just your, like we said, now we're just looking at it on an actual chart. As you can see here, the fair value gap entry model, high of the fair value gap, which is here. So you can see if you see a candle like this, always remember 50% of the fair value gap is a possible order block, like, or possible entry zone. As you can see here, 50% of this is right here, which the trader caught perfectly. Basically, this trade executed out using a 1 to 2. I would say this is a 1 to 3 based on the stop loss here. So the low of the fair value gap on the point of interest, as you can see there, and there was basically a change of character or break of structure, and basically that's one of the 3 or 4, 5 possible when identifying a order block. As you can see, to take a fair value gap, we'll use the same tool as the pricing model. Okay, so basically the same pricing model. We'll drag it from the big candle after the point of interest until the first week, which is right here. Until the first week, that pullback on the market. The 50% will be used for the entry, and the stop loss will be below or above the initial point of interest you place. So as you can see here, here's your stop loss right here, which is this here. I think he swapped it around because the green is always there. On our trading view, it's like swapped around, but okay, that doesn't matter. As you can see, just here below the point of interest, which is your point of interest is this red block here, and the stop loss is just below that, as when you place the trade.
Yeah.
And that's basically the chapter.
Chapter 7.
Chapter 7. As we can see, I'm just gonna go back up and basically just look at what we cover. We just also, I wouldn't say as big as liquidity and supply and demand, but it's also a very core chapter, I would say. which is the few entry models we've looked, and basically we have the C1 entry, and here we have more change of character police model, and that's on top. So basically that was chapter 7, and that is the video for the day.
Yes.
And if you found value, obviously we will spot you in the next one. And I think we're reaching the end of the series so far. We have about 2 more chapters to go, 3 more chapters to go, and yeah, I think this tool should equip you to actually start trading. And like I mentioned in the last video, even though I'm wearing the same t-shirt, make a demo account and obviously practice this, because that's where you're going to get the most learning experience, even though in having the theory, but also good to have the practical. So yeah, we'll spot you in the next one. I'm Curtis. I'm not a Mr. I'm Curtis.
Mr. Perfect. I don't know what he's talking.
I'm Curtis, but Mr. Curtis. But we will spot you in the next video, guys. Peace out.